Good afternoon. The verdict came in overnight, and it is the strangest one of this cycle. Alphabet beat on revenue, grew its cloud business 82%, added $50 billion of order backlog in a single quarter, and the stock fell 7%. Tesla beat on revenue with a record delivery quarter and fell as much as 14%. The market did not punish failure last night. It punished the bill. Alphabet raised its spending ceiling to $205 billion. Tesla burned cash for the first time in 2 years, and while everyone was reading earnings, oil crossed $100 a barrel. Yesterday we called it a capital spending referendum. The referendum passed. The currency it is paid in just got repriced. Let's take it in order. Here's the board, and today it is one color. The S&P 500 is down about 1.2% near 7,350. The Nasdaq is off more than 2% around 24,900, with the big technology names leading the selling. Brent crude took out $100 for the first time since late May and printed $100.70 mid-morning. Gold, interestingly, opened below 4,100. Softer because the metal is more worried about a hawkish Federal Reserve next week than it is comforted by the war. Bitcoin is near 64,800, down about 2%, selling off right alongside the technology complex. The 10-year Treasury yield sits near 4.66%, and the dollar index is quiet around 98. One note of discipline: no reliable same-day print on the volatility index, so I am flagging it rather than guessing. The signature segment, consensus versus the read. First, the consensus looks at Alphabet down 7% and concludes the artificial intelligence trade is cracking. The tell says demand just printed its best number ever, and the market repriced something narrower. Who pays? Alphabet's cloud backlog grew $50 billion in 1 quarter to $514 billion. Customers are contractually queuing for computing power faster than the company can pour concrete. The chief financial officer said the capital spending raise is an acceleration in the delivery of capacity to meet growing demand. That is not a bubble deflating. That is shareholders telling a company that somebody else should fund the build-out. The read with high conviction on the structure. The trade is bifurcating. The companies writing the checks get marked down on free cash flow. The companies cashing the checks, the chip makers, the power developers, the builders, keep the earnings. Second, the consensus says $100 oil confirms the supercycle. The tell says the premium changed species last night, and that forces some honesty from this desk. For 2 issues, we said the war premium was built on words. Last night it stopped being words. Iran-backed Houthi fighters hit 2 Saudi tankers in the Red Sea, 1 caught fire, and Brent crossed 100 for the first time since May. The two-sided risk read survives. A credible ceasefire headline would still vaporize dollars of premium in an afternoon, but the floor under the premium is now physical, and the escalation logic is mechanical. The American president says a bridge or power plant inside Iran gets struck every time a vessel is attacked. When retaliation runs on a formula, the market prices the formula repeating. Moderate conviction now, wider error bars in both directions. Third, the consensus says the crypto bill's ethics deal clears the path, so Bitcoin resumes higher. The tell says Bitcoin at 64,800 is trading like a Nasdaq proxy, not a policy option. Look at the week. The single biggest procedural blocker, the ethics text, got agreed and published. That is genuine progress toward the 1-yard line, and Bitcoin fell 2% anyway, right alongside technology stocks. The lesson is old and worth relearning. When risk assets get sold, Bitcoin is a risk asset. The regulatory unlock only prices in on a tape that is willing to price it. And our tripwire from issue 51 expires tomorrow, July 24th. No cloture motion has been filed as of today. The bill can still pass, and Bitcoin can still not care for a week. Both things are true. Follow the money. The regime tightened a notch overnight. Energy-led inflation risk is now pressing directly on an equity market that just lost its tolerance for capital spending. Start with the bill nobody disputes. Alphabet will spend up to $205 billion this year, raised $15 billion above the range that already made investors nervous, and the second quarter's $44.9 billion ran at double last year's pace. Tesla put $5.8 billion into artificial intelligence and robotics in a single quarter and burned cash for the first time in 2 years, with $25 billion of full-year spending confirmed. All of that is accelerating into a tape where the 10-year yield sits at 4.66% and June's inflation readings re-accelerated. Money at these rates makes a $200 billion program a real argument with shareholders. Last night, the shareholders voted first. But route the same dollars one step further and the picture inverts. Every dollar Alphabet is punished for spending lands as revenue at a supplier. The chip fabs, the memory makers, the power developers, the data center builders, and the $514 billion backlog says those dollars keep coming under contract. Oil is the complication. Brent over 100, with a formula-driven escalation ladder, is an inflation input arriving exactly 1 week before a Federal Reserve meeting the market wants to read as a hold. Gold softening below 4,100, despite the war tells you what the metal actually fears. A hawkish Federal Reserve and real yields, not tankers. The dollar near 98 is quiet. For now, the war trade lives in one commodity, and crypto sits at the bottom of the risk stack. Washington gave the bulls what they asked for procedurally, and the tape took it away cyclically. The sentiment beat. Across market and social sentiment monitoring, the commentary layer that has been structurally bearish on artificial intelligence spending finally has its day, and the tone is victory laps. The fashionable line this morning is that the capital spending emperor has no clothes. The tape says something more precise. The selling is concentrated in the spenders, not uniformly across the complex, and the loudest bearish commentary is citing the stock reaction as its evidence rather than the demand numbers underneath it. When the argument for a collapse is the price action itself, and the demand data points the other way, that is momentum wearing the costume of analysis. Worth respecting, not worth following blindly. Hold 2 numbers in your head, because the gap between them is today's whole story. Alphabet's cloud backlog grew $50 billion in 1 quarter to $514 billion. That is contractual demand. Customers signed up for $500 billion of future computing, and the stock fell 7% the same night. When demand at record highs coexists with punishment for building capacity, you are not watching a bubble pop. You are watching the market renegotiate who finances the boom. The last time capital markets ran this argument, in telecom at the turn of the century, the operators who overbuilt got wrecked, and the traffic still grew for 20 years. Both facts mattered. Sequence decided everything. Sectors in play, big technology. The bull case is that demand is proven, an 82% cloud growth rate and a record backlog. The bear case is that the market just started charging for capital spending instead of rewarding it. The read. This is a repricing of the funders, not of the build-out. Energy. The bull case is $100 Brent, physical attacks, and a mechanical escalation formula. The bear case is that the premium still evaporates on one credible truce headline. The read, highest variance sector on the board. The new floor is physical, the ceiling is political, and semiconductors. The bull case is that Alphabet just guaranteed another $200 billion of end demand and said next year goes higher. The bear case is that they trade with the Nasdaq on red days and Intel reports tonight. The read. If the bifurcation thesis is right, this complex should hold up better than the spenders this week. That is the test. On the radar, tonight Intel reports. The first supplier verdict after the spender markdown and the first read on the bifurcation. Tomorrow, July 24th, our cloture tripwire on the Clarity Act expires. No filing by today and the bill likely waits until autumn. July 27th, China's Kimi K3 model publishes its open weights, and the compute scarcity thesis becomes independently testable. July 29th and 30th, the Federal Reserve meets. With oil above 100 and sticky June inflation against a market priced for a hold. The statement language is the event. And the 4th and 6th of August. SpaceX's first-ever earnings report, then $116 billion of insider shares begin unlocking, now arriving into a risk-off tape, with a Starship flight planned this week as narrative fuel against that supply cliff. The scorecard, first, the grading, because yesterday's headline call resolved. We said Alphabet does not cut its full-year capital spending guidance. They did not hold the range. They raised it to between $195 and $205 billion. Graded correct, emphatically, and the broader call that no major cloud builder cuts spending through the third quarter is strengthened. The SpaceX trigger clause call stays open, and the risk-off tape works in its favor. The oil call is open and honestly stressed, as covered. 2 new falsifiable calls dated today. 1. The bifurcation holds. Semiconductors outperform the big spenders over the next 5 sessions, through July 30th, falsified if the chip complex falls more than the spenders on the week. 2. Tesla does not reduce its roughly $25 billion spending plan at its next quarterly report, falsified by an announced cut. And the question worth sitting with tonight, when a market punishes its best company for its best quarter, who is actually being disciplined? The company or the crowd that priced perfection? Alphabet's customers just signed up for $514 billion of its future. Alphabet's shareholders just fined it for building the capacity to deliver it. One of those two groups is wrong about the next 5 years, and they cannot both be. Frankie's deep dive today is exactly this paradox on the channel now. This is Earl, the asymmetric signal, one contrarian read a day. Subscribe.